Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Doug Fullaway with 14Plus company. Welcome to the show, Doug.
Oh, thanks for the opportunity.
Awesome. Thank you. So Doug is a specialist in senior living and assisted living facilities. He helps out and facilitates many investors and companies looking to invest and get into this sector. Doug is president of 14Plus. His company specializes in the growing market in senior living. The senior living market has grown faster than any other demographic and has produced returns superior to any other asset within real estate sector. Mr. Doug brings unique set of experiences, as he was also the CEO of Vigilan, which was one of the largest suppliers of software, selling thousands to senior living communities. He holds industrial engineering and an MBA from Harvard Business School. So it is a stellar background, Doug. Thank you. In your own words, give us some background and we can get it started.
Certainly. I started off my career as an industrial engineer. I was an officer in the Marine Corps during the Vietnam era, and then I went back to business school before I started in the high-tech world. I lived in the electronic design world for many years. And in 2002, a friend of mine came and said, there's this little company that I think is going to go out of business, and I'm thinking about buying it, and I want to have you help me look at it because I think they have sales problems. Mm-hmm. I said, great, what do they do? And he said, oh, they do assisted living software. And I said, what's that? I'd never heard of it. I honestly, in 2002, didn't know what it was.
Interesting.
But I will tell you, I started off by looking at the software and going out and visiting customers and realizing it was an amazing business, actually. Mm-hmm. I'd been in the high-tech world and done lots of things there, but I got myself into a business where not only was it technical and software and how do you understand how to run the business, but it was really about taking care of people, people like my mom and my dad. Mm-hmm. And there's a great satisfaction that comes from that. And I can tell you, in all my years in high tech, I never had a nurse come up to me and give me a big hug and say, thank you so much for what you're doing. Mm-hmm. It's a very different world because it is all about taking care of people. And yeah, there's a business and it's very complicated at some level, but it's very, very rewarding. And little did I know, I'd stumbled into the type of real estate that produces the best returns.
That's awesome.
For a long time, I found that a little unbelievable. But as the years went by and I saw what happened, I learned why. Mm-hmm. If you compare the returns in the senior living spaces as mm-hmm. compared to multifamily, mm-hmm. Senior housing over the long haul outperforms by about 4 percentage points on an unlevered basis. It's rock solid. And the reason for that is not complicated. When the economy goes bad, multifamily often goes down in some ways. Mm-hmm. Mm-hmm. When the economy goes bad, senior housing doesn't change because you have an 82-year-old lady who's paying the bills and they really don't care what happens to the economy. They still need help. Sure. They don't move out. They don't stop paying their rent. For example, right now with the COVID pandemic hitting, you might think, oh, big problem for assisted living. Well, no, it really hasn't been. Mm-hmm. Yeah, census has gone down a little bit at the moment because we stopped admitting people just to be safe.
Sure. Mm-hmm.
But people are still paying their bills. Sure. And mm-hmm. the mortgages are still being paid on time. Mm-hmm. So that's why this segment has performed. Now, maybe COVID will hit hard enough that won't be true anymore, but I I kind of think it's going to stay the same. So
that's awesome. That's awesome. Thank you for that, Doug. Now, let's get started, Doug, here. For somebody who doesn't know what exactly is an assisted living, can you maybe kind of paint a picture of how, what services are there, what it is about, and things like that?
Yeah, certainly. So assisted living is really a place where people move largely because they have a need, and that is the need with what's called activities of daily living. What that means is somebody needs help with bathing. Maybe they're not quite as agile as they used to be, and getting into a bathtub is a bit difficult. They need help with just pure ambulation, walking to dinner. They don't walk quite as well as they used to. They certainly need help with their diet. They almost always need help with medication management. So there are all of these healthcare things that are done. And then the other component that's very important is the social side of things. 90% of people over 75, if you ask them, do you want to move to assisted living, will say, no, I'm not interested. But nevertheless, about 12% of them actually will eventually move in. And the reason they'll move in is because they have a real need. They need help with things. Now, there's some variants on this. You can think about a continuum, and as we go across the continuum, we'll keep seeing increasing levels of care. The senior housing world really consists of active adult, those over 55. That's just like an apartment. It's just age restricted. And so if you know multifamily, you know 98% of what you need to know to do active adult investing. It's really almost exactly the same. The next step up in care is independent living. I think of that like a college dorm. That is, there's a kitchen, and meals are served, and there's probably occasionally some activities, but it's very much people on their own. They're independent. And again, that's awfully much like multifamily.
Sure.
Now, we take the next step, which is assisted living. I do need help with things. And then there are some more steps. There's memory care. And memory care is inside of 40% of assisted living communities. And they go in the building and they have both, because the facts are that when you get to be 80 years old, something like 85% of the population will have some form of dementia in due time. So that's just assisted living with extra care so that those people are safe. And then there's another segment above that, which is skilled nursing. Skilled nursing is, in a way, like a junior hospital. I don't recommend you start investing there, even though it's a very large segment. The average net, or the median NOI last year, was minus 0.1%.
Wow.
It's complicated because it's almost all government pay. Whereas all the other segments are 92% private pay and 8% is paid by Medicaid. So, if you're going to get started and you want to move from multifamily, the easiest place is to start with active adult and independent, then to move to assisted. And by the way, if you go to a campus that has independent, assisted, memory care, and skilled nursing all on the same campus, there's a term for that. It's called a continuing care retirement community, or a CCRC. And those are places people typically buy into so that they can stay there. And those mean people move in and they don't leave. They stay the rest of their life.
I see.
That's also a very complicated segment. I don't recommend starting there because it's dominated by, quite frankly, not-for-profits and the churches. They don't have to make a huge return, and it's very difficult as an individual to invest there.
I see. Now, Doug, a lot of multifamily active syndicators and operators listen to the podcast, and it sounds like it is an area that they can also venture in, right? What would be some of the first steps that someone can, if they are interested, how they can learn more about it and try to research the market and things like that?
So I have 3 ideas of things you could do. I would start by going to the website, nic.org. That stands for the
bro.
National Investment Center,
Mm-hmm.
which is a sort of a trade group of all the senior living businesses, and it's completely focused on the financials and raising money. They have very good information. There are lots of references there, and it's kind of considered the authority on those things.
Mm-hmm. Mm-hmm.
The next place I would go would be to an organization called argentum.org.
Mm-hmm.
Argentum is the assisted living organizations across the country.
Mm-hmm.
And go read and understand what they're doing. There's lots of good information.
Mm-hmm.
The third thing I would say is I actually wrote a book about investing in senior living.
Interesting.
Right now you can go to Amazon and get it, just investing in senior living.
Mm-hmm.
Not to be confused with somebody copied mine and it says investing in senior housing, because it's a very different book actually. But anyway, I would suggest that if they'll just go read. Now, if they'll wait a few weeks, I'm going to post it on my website, 14plus.com, and you can download it for free. And I wrote about all the things you should know about the economics and the returns and the problems. And in the back of the book, there are all kinds of, websites to go to, publications to subscribe to, events that go on. So for example, there's a conference that is put on in different regions around the country. It's not expensive to go to. It's about $400 to attend. Sure. And you'll see 300 or 400 people for a day. And you can meet the people and you can talk to them and get their business cards and start to learn.
I see. So what are some of the few basics that we can look at it? Like, let's say if someone needs to say that, okay, I want to research independent living area as a first step. What are some things? Like, is it the market? Is it the sort of the aging demographics and some of those trends?
So the first thing I would say is, this business is very unlike multifamily in one fundamental way, and that's labor.
I see.
If you have 100 units of multifamily, you might have 2 to 5 employees.
Sure.
But if you have an assisted living community with 100 people in it, you have 55 employees.
Wow. So it's like almost like a 2:1 ratio, huh?
Yeah, it is. It's almost. And those vary a little bit, but,
sure.
But the point is, you're not going to learn all the rules and regulations quickly. And you're going to find the best thing to do to invest is find the operator.
Interesting.
And if you go to the state association, Argentum has those, and there's another one called the American Healthcare Association that has them. And you go and attend their events. You can literally get a book with all the operators in your state. You can go online and start to find them. And the key to all of your success is the operator.
Sure.
Because if you find the right operator, they can take a really sad old building and make it sing, and you'll make a great return. I just helped somebody recently acquire a property that had been doing okay, but not really that well. And the trick was the operator stepping in has 25 years of experience, and he knows how to make these run very effectively. And the return the investors will see, they're going to see a 10% cash on cash yield the first year.
Wow.
It goes 10, 12, 14%. So it's easy. And that makes a really attractive investment because they're buying something that's already cash flowing and they're going to improve it.
Sure.
And even if they don't improve it, you're still going to earn 10% cash on cash. So that's step one, is find that operator. The other thing you can do is you need to get intimate with the buildings and the communities where these are located, and they're everywhere. Go visit. Go do a mystery shop. Gee, I'm thinking about this for my mom in the future. I think she's going to be reluctant about moving. Can you tell me about what you do and how you do it? Tell me why she might want to move in. Show me the building. Tell me what it costs. People will be absolutely happy to help you with that because they see you as a future customer.
Sure.
And it's a great way to learn. You'll learn a lot by going and doing that. It doesn't cost anything, takes some time. And after a while, you'll begin to realize pretty quickly, oh, I can identify a good operator. And it's not a complicated technical thing.
Sure.
This business is about taking care of people. and you can sense that hospitality pretty quickly. And then you can ask the technical questions about how do you actually deliver the service? How do I know that mom is going to get all the help she needs? How much is that going to cost? It's not complicated. It's pretty much common sense.
I see. Now, speaking of the asset evaluation itself, Doug, how does that work? Are we kind of basing it off of the NOI, or
yes,
how
that's a
does that
great
work?
question, actually. The first thing I would say is much of what you do in evaluating and valuing the business is exactly what you're already doing in the multifamily world. That is, how much is this physical asset worth? Well, it's all based upon the operating income, the NOI.
Sure.
And the question is, well, how do I know if I've got a reasonable NOI here?
Right. And
on my website, there's
sure.
a resource. There's a spreadsheet that I have that says, oh, here's one that's all independent. Here's what the median returns are. And it includes, here's what the revenue is per unit. Here's what the cost for labor is, the cost for advertising. All those costs are all there so that you can compare a potential investment to those national median numbers. And you can do it pretty quickly. And that's a great way to start. And then these trade at, cap rates, which are a little different than the world of assisted living. But if you go to Marcus and Millichap or CB Richard Ellis, they publish papers all the time about what the cap rates are and what the values are and what the challenges are. So my guess is you're already used to looking at those things. You just need to ask to see those things. Typical assisted living is definitely going to be in the 7 to 8% cap rate. But of course, this is like multifamily. The A markets are dominated by large institutional investors, and it's very difficult for an individual to compete with what they'll pay because they're only trying to earn a 6% return.
Sure.
And that's not very interesting. Whereas if you go to the B and C markets, you definitely can find great opportunities because there's so many.
Sure. Now, speaking of population, sort of the transition and the trends and things like that, we always like to say that Sunbelt states, whether it's the Arizona, the Texas, the Florida, Tennessee, and Carolinas and things like that, they are experiencing that demographic shift, as we call it. Speaking of this assisted living as well, is the trend similar to multifamily? Are we seeing the same flight from colder climates to warmer climates and things like that?
Yeah, that's a very good question. And the answer is yes and no. Let me explain. The first thing to understand is that in 2015, there were approximately 20 million people over 75 years of age. Today, that number has gone up by 3.5 million. So it's now 23.5 million people. Well, approximately 10% of those have moved to some kind of senior housing.
I see.
Well, over the next 10 years, from 2020 to 2030, there are going to be 11 million more people over 75 years of age.
Wow.
And most of those people, if they grew up in a small town in Iowa, they're not moving. They're going to stay in the small town in Iowa. So that's maybe a little different than multifamily. They're not moving. They're going to stay where they were. Having said that, there are lots of people in New York or in Michigan tired of the cold weather, and they move to Florida. They move to Arizona. So yes, you see the same thing. I think the important thing is, just like in multifamily, you want to understand the demographics in that specific local market where you're thinking of investing. And I always like to look at a 20-minute drive circle. And people say, well, 1, 3, and 5 miles. Well, you can go farther than 5 miles in 20 minutes.
Sure.
And people will drive 20 minutes to see mom in an assisted living community.
Sure. It's very much different than, like, for example, we talk about that 1 3-5 mile radius in self-storage, but as you rightfully pointed, someone can drive 15-20 miles to just see their loved ones for sure.
Yeah.
Got it. And another question, Doug, it seems that as you alluded to, the operations and sort of the optimizing the different things around running an assisted living, that's where your NOI increase is going to be, right? But how do we know somehow? I mean, it's a topic that, for example, in multifamily industry, we understand that, hey, renegotiate the contracts, perhaps look into, adding some of the, interior lighting fixtures and, all the other jazz that comes with renovations and things like that. But it seems that in assisted living, it's a whole different way of how you are adding the value. Can you maybe perhaps go into some of those points, Doug, as to how we
Certainly.
optimize
Yeah,
the
that's
observations?
a very good question. The first thing I would say is, yes, all those things you're used to in multifamily actually all apply in senior living.
Interesting.
People, just because you're 80 years old doesn't mean you don't want a nice dining room. You do.
Sure.
You want to have a nice room. You don't want it to be run down. You really care for someplace at your home. Now, part of the things that's very different where value is added is in the care services. It is, for example, very often the case that when I look at something, I just did an underwrite for a family office, and the revenue in terms of the room rentals came to about $3 million.
Wow.
The care services was another $1.1 million of revenue. And if you have too much labor, you're not going to make money. If you don't have enough labor, you're not going to deliver quality, and because of that, your census will go down.
Sure.
So managing the labor force to have enough, but not too much, managing what's called the assessment, that is the understanding of the needs of the senior, and then translate it into the services. Am I going to come in once a day to pass medications, or twice, or 4 times? Am I just going to remind somebody to take a bath, or am I going to assist them, or am I really going to have to get in there and help them bathe? That's a very hard thing to do.
Sure.
Don't realize that in an assisted living community, we'll often deliver 5,000 services a week.
Wow.
How could that be? 100 residents? I mean, what is going on? Well,
sure.
3 times a day for medication management, 3 meals a day. And I have to get them both to and from the meal because they have a walker and it's a very difficult thing for them. And they don't want to sit in their room and be hibernating. They want to come out and play cards or listen to music, or they want to go to a movie with people. You see where it's different. And that's why I come back to the point I made earlier about it's the operator that matters here. The way you add value is you deliver a quality of life in a way that assures the resident and their family that it's safe. The family is paying for peace of mind. They want to know everything's okay. They want to know that mom is getting great service. And this is why you can take a rundown older building. You don't have the capital to improve it, but you can take it over and fix those things. And the value goes up enough that you can now turn around and borrow the money to now do the physical plant upgrades to the building. And very often, a great strategy is to do a value add acquisition of a broken building. Okay, somebody's retiring, or they haven't maintained it well, or it's 18 years old and hasn't had a rehab done on it for over 10 years. I consistently see that you can acquire that, run it properly, and double its value in 5 years.
Wow. Incredible.
Which means you're going to produce 17, 18% IRR. It's the safest way to grow the business.
That's awesome.
If you go to building new buildings, that's a little more difficult. And the thing I would say there is there's a massive opportunity that people recognize but really hasn't been addressed. When the industry started, people built things that were the top end of the market, make it like the Ritz-Carlton.
Sure.
I don't have to spend that much more money. I can charge more money. I can make more money. Well, that market's sort of overserved in many markets because there are some people on the other end who've run out of money and they depend on Medicaid. But there's the forgotten middle. There are 14 million seniors who can't afford $5,000 a month. They can afford 3, And this is a huge opportunity that's not met yet.
Right. And I was just going to ask you about that as well, Doug, is that depending on the, I guess the person or the individual, like the level of care or what sort of intricate things that they would need, because somebody might be just, let's say needs, perhaps walking and, to and from. But there may be other folks who may have, some form of dementia. They need reminding, or some people may need intensive care. I mean, how do we classify that, and what sort of is the intelligence behind it? And what's the right balance, I should say?
That's a great question. Let me explain sort of what the industry does and where there's a real opportunity for a new owner investor in a group. Mm-hmm. The way the industry works is they have what they call packages or levels. Mm-hmm. They'll say, oh, you're going to move in. You get level 1, which is you're going to get your apartment is going to be cleaned once a week. We're going to change the bed for you. We're going to make sure you have 3 meals a day. Mm-hmm. And we're going to do a health check once a month. And for that, we charge, $100 or $200 a month. Mm-hmm. And then they say, oh, but then you have to have these 5 other things. Mm-hmm. Well, that's going to be $800 a month on top of your rent. Mm-hmm. Or they bundled it into the rent. So that, and unfortunately, when they do that, they often make a mistake.
All-inclusive package of sign.
The thing you can understand is, look, if I have an apartment that I could rent as a normal apartment in this market, if I went out to rent just a private apartment someplace, and it was $1,600 a month. Mm-hmm. Well, think about $1,600, but because I'm going to have some social activities and other things in a setting that's amenable, maybe I'm charging $2,000 a month with quote no care. Mm-hmm. If you then pay your caregivers $15 an hour, add 15% for overhead and 30% for your margin, you come out at $25 an hour. So you can say to somebody moving in, I will deliver the services you need, only what you need. You don't pay for things you don't need. Sure. At $25 an hour. And people go, oh, wow, wait, how much to pay to have your car fixed? It's a lot more than $25 an hour. Sure. Mm-hmm. And this is about taking care of your life. Sure. Mm-hmm. So all of a sudden, $25 becomes a more reasonable number. Mm-hmm. And now, as each individual's needs change, you can flex the amount of care, never discount that. Mm-hmm. It's care. We have to hire good people. We have to train them. We have to keep them. Mm-hmm. We have to pay them a reasonable wage. Mm-hmm. We can't pay them $11 an hour like they do at the local hamburger joint. We can't keep them.
Sure. Now,
so all of a sudden, that value conveyance is easy to understand for the buyer. Mm-hmm. And now you can control your margin on the care service at 30% or better.
Sure. That's interesting.
And so just doing that can take a very poorly run building and turn it to profitability very quickly. When we were selling software, we always said, look, pay for our software. It's $10 a month. And we will promise you in writing $100 more revenue per person per month by just keeping track of the services and charging this way. I never had to pay the money ever.
Nice. That's nice.
So that's sort of you can't get the balance right, as you said. What you can do is you can flex the amount of labor with the amount of care service so they match.
I see.
Now you're in a great shape.
Got it. Thank you. Now, Doug, speaking of, at a global level, when you're operating the business, right? How do you sort of classify the expenses that come with this? Like, is the operations of running all of this, is it more like 40%, 50%? How do you kind of
there are a couple numbers,
all of that?
Yeah, there are a couple numbers that are worth knowing. First of all, the median NOI for assisted living is about 35%. Now it varies. You may say, well, I'm trying to make my product very affordable, and I'm in a market where people can't pay that much, and so you might settle for a 25% number. But so 35% is normal.
So are you saying maybe 25 to 35 is the sort of the NOI off of the gross income. Is that what you're saying?
Yeah, I'm saying that the net income is 35%.
I see. Okay.
It could be a very profitable business. Now, there's another number it's important to know. Remember, labor is a big component.
Sure.
Labor costs typically will be between 37 and 40% of the effective gross income. So it's your biggest number.
Sure.
And it's the one you want to check first.
Oh, that's a huge deal. Absolutely.
Yeah, that's a huge deal. And you want to make sure it's well understood and well managed, because if you get that right, the rest of it is stuff you know how to do already.
Right. Now, speaking of some of the sort of the issues of liability that comes into all of this, Doug, because we are dealing with seniors, some of the care, some of the emergencies and ambulance and all of that comes into all of this kind of opens doors for liability. How does an sort of an asset owner insulate themselves from some of the liability, or is it the liability is more on the operator side? How do we go about
So the liability, I mean, there are two things to do. The first thing I suggest is you have an operating company and you have a property company.
Sure.
And as the investor, you want to own the property company and you want to hire the operating company to operate effectively for you. Now you've got one step between you and the lawsuit.
Sure.
That's why it's done. Okay. Now, the next thing to do is make sure that the operator has a good set of risk management and that's well documented, their procedures. The other thing is, don't overreact to this. The insurance is 0.8% of the expenses.
Wow.
That ought to tell you something.
Sure, absolutely.
And not to say, I've been personally sued. The deductible took care of it and the lawsuit went away. And yes, it's an emotional thing, because when somebody dies because they haven't been cared for well, they're going to sue for wrongful death.
Sure. So, but I guess
it doesn't happen that much, quite honestly. It's very rare.
I see.
Everybody right now is talking about, we're going to get sued for COVID. No, there's a law just passed that says, if you're doing the things the right way, your liability is going to be limited. So I don't want to downplay it as it's not an issue. It's an issue.
Sure.
But it's not nearly as bad as people fear. And when you see the insurance costs, you begin to understand why. It's like, because the procedures to manage this are all well understood. Every state has regulations. There are 50 sets of regulations out there. They're not complicated. But they're all written down. And they come and inspect to make sure you're doing them, and your staff has training to understand how to manage those things.
Sure.
So it's pretty much, it's like flying an airplane. There's a risk, but we require that we have licensed pilots. It's the same thing in assisted living. We require that we have a licensed administrator in the building. We require that the nurse who's signing off on the documents has a license. We require that there's training for the medication management person to go through training and have experience. So there are all these risks, but it's a pretty mature, well understood process for everything.
I see. Now, Doug, speaking of, the intake process and sort of the financial due diligence of the incoming customers, or the, sort of the senior folks as well, a big portion is paid by them. And a very small share, I think you said 8%, is shared by Medicare. Can you maybe delve into sort of what goes into due diligence? Like we know on the multifamily side, we say it all the time that, the income should be at least 3 times the rent that you're charging and things like that. But when it comes to, assisted living and independent living and things like that, it is a much higher rent to pay. Can you maybe talk about what sort of the financial due diligence that needs to be done specifically towards your resident?
Yes, I can. The first thing I'd say is take the discipline from multifamily and move it over to this space and just change the numbers, but just be disciplined about it. Typically, it's very helpful to know that the average length of stay in assisted living is approximately 2 years.
That's pretty.
So what you want to
Mm-hmm.
know is, does this person have enough assets to pay the bill for 2 years?
Mm-hmm.
And so people are asked to provide a financial statement,
Mm-hmm.
and you can check. Then you have to make a policy decision. Am I going to make sure they absolutely have it, so
Mm-hmm.
that I never have them what's called spend down? They've spent their money, and now they move to Medicaid, not Medicare. Medicare doesn't pay for this.
Mm-hmm.
Medicare pays for individuals' health care,
Sure.
which they may use
mm-hmm.
themselves to pay for things,
Mm-hmm.
but they're not going to pay the business. Whereas the business of assisted living is often paid for by the state Medicaid program. I'm an owner in a building where we made a policy decision that we would accept anybody day one who needed Medicaid to pay everything. So 85% of our residents are completely paid for by the state of Oregon.
I see. Mm-hmm.
Okay, and so our numbers are a little different, but this is a very small town.
Mm-hmm.
It has very high unemployment, and we pay our investors a 9% return every year. It's not a bad thing.
Sure.
Because if these people didn't have this place, they wouldn't have anything.
Sure.
So the diligence is usually make sure, and what we do in our buildings is we make sure they have the ability to pay for 3 years. And yeah, we're going to lose on some people, but on average over time, it's fine. That's the typical way it's done. The other thing that's done is there's a move-in deposit, a move-in fee. It's often referred to as a community fee, which is any place from $1,000 to $3,000. Average is probably around $2,000. That goes to the building, to the community when they move in, and they don't get it back. And that's done to make sure that if people move in and there's a problem and they move out, you don't lose a lot of money. And it's done to make sure that when you get it wrong in estimating, how long people can pay, you've got some reserves set aside.
Sure.
So the way it's managed is pretty simple. Can they pay for 3 years? And we're probably going to be okay.
Got it. Now, speaking of evaluating the independent assisted facility, for example, how do you kind of factor in the aging demographics that could be sort of prevalent in that submarket, and also perhaps some of the, let's say the occupancy, issues that are there. Can you maybe talk about what goes into sort of analyzing, on the front end? How do we analyze this?
Yes, I will tell you, it's the same players out doing the appraisals. It's CB Richard Ellis and JLL and IRR. It's all the people you already know. They do those. And so you'll get a 30-page document that answers your question in lots of depth. But the things they look at in there that are a little different are, they want to know what the demographics are for 55 and over, 65 and over, typically 75 to 80, 80 to 85, those over 85. And they want to know that demand, as calculated in a simple way, which is if I know what the total is of 75 and over, how many are already being served in that market? In other words, what's the existing supply? The existing supply, including the property you're going to invest in, shouldn't exceed something like 15%. Now, Portland, Oregon is different. 28% of those over 75 have already moved into some kind of senior housing.
Interesting.
So you kind of got to know a little bit about what the local market is. So in Pittsburgh, the people that might have moved in, I haven't checked in a while, but it's like 5 or 6%. So if the supply and demand are out of balance, that's a problem. Now, why is it 5 or 6% in Pittsburgh and 28% in Portland? Well, a bunch of reasons. One, in Pittsburgh, it's a cultural thing. There are lots of 3-generation families.
I see.
They don't move into somebody else, so they stay with their kids and their grandkids.
Sure.
Portland, Oregon, that's not true. Portland, Oregon has lots of senior living communities. So everybody's been in one. I mean, everybody's got a parent who lives in one. I mean, that's how it feels.
I see.
So it's a very competitive market. So the product, there's lots of product at different price point with different amenities.
Sure.
It's not oversupplied because the state is careful about issuing letters to let people build new ones.
I see.
But that's one thing, and you look at the supply and the demand, is to understand first just the pure numbers of people that age and what percent are going to move in.
Sure.
The second thing is it's the same as multifamily. We're looking at income. What's their income and what can they afford? I just finished looking at something in Bradenton, Florida for somebody, and the household income is 10% under the national median.
I see.
So you want to know that the product you're going to sell is going to fit in that market.
Sure.
But the good news is, if you're going to get involved in one of these and there's going to be a transaction, there's going to be an appraisal. And that appraisal is going to lay this out in 30 pages of gory detail, including a careful evaluation of the income statement, because that's what drives the value.
Got it.
So in that case, be careful, because if you get the offering memorandum from the broker, there's no management fee in here, 5%. Oops. Wait a minute. Why am I only getting the trailing 9 that's been annualized? Why am I not seeing all of it? Oh, wait a minute. Why is this number out of whack with the industry?
Sure.
You got to dig in to really understand that.
Got it.
Sometimes when you get the appraisal, you'll find things that you go, wait a minute, this doesn't make sense.
Got it. Thank you for that detail. Now, one last question, Doug. What has been the sort of the hardest part of this business? Whether it is evaluating the markets or whether it is kind of improving the efficiency of the operations. Give us some sense of what is the most challenging part of this business.
I think for most operators and for many investors, the biggest problem is finding each other. It's not like multifamily where everybody knows it and can understand it, and it's everywhere, and there are lots of statistics and lots of tools. It's less mature. You can go in the multifamily space, and if you're going to own large apartments, you can go buy a product from RealPage, YieldStar, and manage to know that you're getting the right pricing because you can do it dynamically. And it doesn't exist in assisted living senior housing. It's less mature. So because of it, some great investors haven't yet moved into this space.
I see.
And so just connecting the right investor with the right operator has been the biggest challenge. That's how I ended up doing what I'm doing.
I see. Interesting insight.
By the way, that tells you if you want to be an investor, if you'll take the time to learn,
sure,
you can do very well, better than you're doing in multifamily. But you're going to have to work at it.
Sure.
Because the big guys are going to go do the big deals in the A markets.
Sure.
And they're not going to understand the B and C markets as well, which means there's some gems out there.
Absolutely. That presents a great opportunity for sure. So thank you, Doug. I appreciate you taking time today. Please share with the listeners how they can find you and learn more about your company. And
while I apologize, it's a long name, Doug Fullaway. Fullaway is just Full, full, away, AWAY. I like the two words.
Sure.
At 14Plus. You just spell it out.
Gotcha.
14plus.com is the easiest way. You can send me email, dougfullaway at 14plus.com, and so on. And I'm happy to try and help introduce you or help you find things. Because to be honest, eventually lots of people come back and say, okay, I want to invest. Would you look at this and help me find something? So I'm happy to be gracious in using my time to help people because it comes back.
Thank you. I greatly appreciate you sharing your insights, Doug. Be well, and I look forward to chatting with you and getting more insights into some finer parts of this business as well. So thank you for coming on.
Thank you very much.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.